And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the Sorrow Rail Conference 2025, powering progress, connecting economies. Good evening. Welcome to the program. I'm Stephen Grootes. 9 minutes now after 6 o'clock. Quite a packed show in store, actually. A lot of market news coming from some of our corporates today. Some of it also around electricity, and staggering to see what happened with Harmony's share price today. I mean, they report a record dividend, declare a record dividend, and their share price still tanks by 10%. Largely, it seems, because that their costs were up so dramatically, and that's because of electricity prices. And in the middle of that, NERSA, I mean, it is really astonishing. I kind of almost feel personally failed by NERSA, because they get their sums wrong with Eskom almost all the time when it comes to tariff applications. Whenever Eskom goes to court, they seem to win. And again, NERSA got its maths wrong. I realize it's complicated, but you are professionals. And as a result, Eskom will be able to put their price up more than expected. And the impact that has on you, the impact that it has on companies is incredible. I really am amazed that this has happened yet again. Well, we'll talk about that in a few moments. We'll hear from Zwelinzima, Vavi and Chris Yelland. We'll hear from NERSA too, because they spoke to 702's John Perlman this afternoon. You'll hear them. A little bit of that conversation is available, I'm sure, for you to listen back to now as well. I thought it was staggering. The sort of lack of accountability was how I saw it, but you'll hear it for yourself and you can make up your own mind. Also tonight, we'll speak to We Buy Cars. The number of people spending times on car websites. It's kind of recreation to go and see what you could have. And actually quite fun recreation in a way to go and see what you could have, although may not make you feel great by the end of it. Also tonight, we'll speak to the CEO of the IDC. A really important conversation if you consider the impact that they have on our economy and how they have that impact. We'll speak to Makhoshi Lekete, and particularly, I think, about the amount of money that's been put into ArcelorMittal. Good to hear from you this evening. 011 883 0702 021 446 0567. I know you'll have a view on NERSA getting its sums wrong. You can send us a voice note too on 072 702 1702.
702.
702.
Stephen is on The Money Show.
6 to 8 p.m.
Well, Impala Platinum reporting its earnings down significantly because of lower demand for platinum, lower prices in the year to the end of June. Also been hit by some bad weather, some other production problems in some operations. But the real story, of course, is the platinum price, which has improved in the last few months. Nico Muller is the CEO at Impala Platinum. Nico, good evening and thank you for your time. You said today you expect platinum prices to be, I think the word you used was supportive for the next 18 months or so. What are you basing that on?
Stephen, good evening. So firstly, I mean, we have been recording market deficits, and so we have thought that the PGM prices have been disconnected from market fundamentals for the last 2 years. What we have seen with recent volatility in macroeconomy, we have seen a surge in the dollar in the gold price, and we have recorded record discounts between gold and PGM prices, with platinum being an alternative precious metal. That's been the one driving force of the PGM prices. And secondly, we have seen physical movement between regions of physical metal, mainly from Europe to, in particular, the US, but also China, and that has meant a reduced physical liquidity. And this is on the back of changes in trade relations brought on by tariffs and the need to secure supply chain of critical minerals. And so we have seen a reduced metal liquidity and therefore an increased price, and we don't see that recovering. In addition to that, we have seen continuous lower supply forecasts, both primary supply as well as secondary, and we have seen lower battery electric vehicle penetration rate forecast, which means an improved demand for our metals. So we are confident that we are heading into better times.
Okay, I mean, obviously it does depend how much production there is. You'll think very carefully about increasing your production, and I presume that so will everyone else.
Well, I mean, all of the major producers report on capital spend, and I think it's been clear over the last period that we have not seen the same level of capital intensity in the industry, and we have seen perpetual deferrals of key projects. Be that our own Waterberg, Ivanplatz, the Southern Cluster in Russia. We've seen production downgrades from North America. So I do not believe that there's going to be a surge in either primary or secondary supply shortly.
Okay. Your processing capacity in South Africa was hit by unplanned maintenance. Are you having some operational problems? I mean, some of it was the weather, and you can't do much about that. But unplanned maintenance does point to a few issues, perhaps?
Yeah, so over the last number of years, we have seen a transition from predominantly Merensky supply to an increased UG2. That comes with a different quantity of base metals, which has an impact on the furnaces in the smelters. And we, as a consequence, have had reduced life, increased wear on the bricks that we use for the furnaces. So we've had to increase the frequency at which we do major repairs, rebuilds, and maintenance. And so that has an impact not only at Implats but on the industry as a whole.
It looks like electricity prices are going to go up significantly again in South Africa. Power prices have had a big impact on Harmony Gold, for example. You're using renewable power for some of your refineries where you can, particularly in Zimbabwe. You've got a solar installation. How is it becoming more and more important for you, and I imagine other people in your sector, to get out of the sort of the Eskom ecosystem as quickly as you can to produce your own power?
Well, I think that there are two parts to that, but I mean, no doubt that we are a large industrial consumer of power, and the rate of increase of power supply is critical to our continued competitiveness in the industry. But the secondary aspect is our ambition to reduce our carbon footprint. So our recently commissioned 35 megawatt solar plant at Zimplats and our offtake agreement with a willing supplier is aimed at reducing future impacts of electricity increases as well as reducing our carbon footprint.
Nikamala, thanks very much indeed. Do appreciate it. The CEO at Impala Platinum. Well, while we're talking about electricity, confirmation now that the energy regulator NERSA and Eskom have reached an out-of-court settlement. It'll see tariffs going up by nearly 9% next year instead of just 5%. This is all because NERSA made a mistake in their calculations. In other words, you're going to pay more for power than you were expecting because NERSA got its sums wrong. Well, earlier today on 702 Drive, John Perlman spoke to the executive manager for electricity at NERSA, Rulani Matabula.
The question is a factual one, Mr. Matabula, the context that you sketch out notwithstanding. A serious error was made that has grave consequences both for consumers and for the companies and small businesses that are meant to drive the country forward economically. Have there been any consequences for anyone at all at NERSA? I mean, the answer surely is just a simple one of fact.
Yeah, no, look, John, the consequence management process, it's embedded in any organization, so that is taking...
I'm asking you about your organization. Has anyone suffered any consequence? Perhaps the answer yes or no, as yet, as we sit at the end of August.
No, remember that this decision that we talk about has been concluded recently.
Okay.
So that process,
no consequences yet.
That process is unfolding within the organization.
Thank you so much, Rulani.
Well, we were due to speak to Chris. That was Rulani Matabula, the executive manager for electricity at NERSA. He spoke to 702 Drive's John Perlman. We'll speak to Chris Yelland in just a moment, the electricity expert, that line dropping. But let's hear first from Zwelinzima Vavi, the General Secretary of the South African Federation of Trade Unions. Zwelinzima, good evening to you. This is going to have a big impact on businesses, on the poor, on workers, on everybody. And once again, it's because NERSA got their maths wrong.
Yeah, thank you very much for inviting us, Stephen, and good evening to you, your colleagues, and everybody listening. Can I take the opportunity to pass our deepest and heartfelt condolences to all of you at 702 Land, to the family of the flower of South Africa, the ace patriot that have demonstrated her love for her country, for many years as she was doing her journalist work, Tshedi Madia, and her sudden passing away have simply shocked everyone in South Africa. All of us who are leading institutions have interacted with her, and we know her honesty, her upfront, upright way of relating to the political powerfuls, trade unions, everybody that holds power in society. She will be dearly missed for many years to come, and her passing made me in particular to remember Xolani Gwala, another shining star of Radio 702 land, and his passing have not yet really dawned to us as a reality. And
Thank you
condolences to all of you guys.
Yeah. Thank you, Zwelinzima.
Now,
It's been a very
terms
tough
of
time.
this, it's tough. I could hear everybody that have been paying contribute. That lady, young as she was, have touched everybody's life in a very special way. Strength to her family and strength to all of you guys. Now,
Thank you.
on this one.
No, sir. Yeah.
On this one, tough one, isn't it? 54 billion rands mean 8.7% increase in tariffs in 2026-2027, 8.83 in 2027-2028, and 3 times the rate of inflation. And it makes South Africa to be now the highest electricity price in Africa, and in a context where 62% of its population live below the upper bound poverty line of 1,558 rands a whole month. It will deepen energy poverty as the poor will be forced to disconnect, and more families are now having a reality of the kettles, the geysers, the stoves being reduced into white elephants within our homes. Nobody can afford those things anymore. People in the townships, informal settlements in the rural areas are now fetching wood again, reversing the whole gain of electricity that have nearly reached universal access in South Africa. The municipalities are going to be hit very hard. The small businesses, the industry as a whole, which is shedding jobs already because of deindustrialization that have reduced our manufacturing capacity by 50% between 1994 and to date. So this is going to be absolutely devastating. We are very, very sad that the court have accepted this settlement, but it goes back to the point of the structural deficiencies on the part of Eskom, and that's why we are calling for the debt cancellation, in particular of the Eskom odious debt. World Bank in particular have funded projects like Kusile, knowing very well that it was funding corruption. And what makes us to be angry is to know that the people who corrupted Eskom are now called honorable MPs in the National Assembly and elsewhere. We're calling for a massive public investment again on the renewable energies, storage and transmission. We're calling for the national program to roll out free basic electricity for all households with progressive block tariffs to cross-subsidize the poor. We're calling for on Eskom and municipal jobs to be protected in the transition. And we're calling for the prosecution of all of the people who have created this mess. They all here. They have not died. And this is what makes us angry. The Zondo Commission is largely gathering dust in the office of the president and the NPA. We have not seen a single person in prison because of all of this mess we are now paying for.
Zwelinzima Vavi, thank you so much, and for your messages of support. The General Secretary at Saftu. Listening to this, Chris Yelland, the Managing Director at EE Business Intelligence. Chris, good evening. Do you expect anyone at NERSA to be held accountable for this? They get their sums wrong all the time, it seems.
No, I don't think anybody will be held accountable. Ultimately, this is apparently a mistake made apparently by NERSA, which is going to mean an increase in the price of electricity by about 18%, spread out over 3 years. And I must say that this is not where it ends, because there was a previous judgment just recently, before this settlement, which takes this clawback up from 54 billion to over 90 billion. And again, the impact of this is to add to this 18% and make it 31%. So what we don't know is over what period of time this is going to be clawed back. What Eskom have announced, NERSA have announced 2 price increases in the 26-27 financial year, 27-28, over and above the multi-year price determination. They've announced this. But in effect, the total increase is going to be more like 18%, up to 31% if you take the previous court judgment into account, which also has to be implemented. We're not quite sure over what period. So, yeah, it is a massive impact, and it doesn't look like anybody at NERSA is going to be held accountable.
Chris Yelland, thank you so much. What a mess. Chris Yelland, of course, is the Managing Director at EE Business Intelligence. 25 after 6.
The Money Show.
The markets.
Graham Kroner is at the Corner Perspective. Graham, good evening. I mean, electricity and prices starting to have an impact on financial results, as we saw with Harmony today.
Yeah, good evening, Stephen. Absolutely. It's almost surreal. And I think, Zwelinzima said it very well that, these increases are 3 times the official inflation rate. We're trying so hard, to get interest rates down. Inflation was anchored at 3%. And more recently, obviously, food and beverages helped propel. But water, electricity, rates and taxes, those are definitely the things that are keeping or threatening, let's rather say, inflation starting to go higher. So very, very frustrating. But this is the price we pay for, the corruption, the maladministration, and the capturing of Eskom.
Impala's results today, lots of interesting conversations around the outlook for the platinum price. I thought Nikomala sounded quite optimistic in some ways.
Yeah, I think the results were a little bit strange. And of course, when you're in the thick of results season, you sort of almost look at the headlines. So my takeaway was the second half was obviously tough, probably added to by electricity costs. But, it's we have become a little bit more optimistic. I think we've spoken about it before, Stephen, that you've seen the metal prices ratchet up. And I think Nico was saying today at one forum that, the producers who hold excess production must drip feed that into the markets. But, you've seen the platinum price rally from 950 to almost 1,000, currently at about 1,350. So, yeah, the outlook is a lot better because last year, let's be honest, it was tough for them. Revenues in rands almost flat if you look at per ounce, and yet the costs, I think, in rands were up 10%. So I think they'll really embrace the higher PGM basket prices.
Graham Kerner, thanks very much indeed at the Kerner Perspective. Really do appreciate the time. You with SAFM, you with the Money Show. It's just gone 28 minutes after 6.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the SARA Rail Conference 2025, powering progress, connecting economies.
17 minutes now to 7 the time. You know the number, of course, and I'm sure you have a view on NERSA on 011 8830702 and 021 4460567. The Industrial Development Corporation announcing today it's been able to increase the amount of money it's invested in our economy by around 2.5%. And that's despite, relatively low, very low economic growth in South Africa. The CEO at the Industrial Development Corporation is Makhoshi Lekete. Makhoshi, good evening, and I really do appreciate the time. Thank you. You've increased the amount of money you're ploughing into our economy. What kind of strategic investments do you believe are going to be paying off for you in the longer term?
Good evening, Stephen, and thank you for having me on your show. Yes, we have increased our investments into the economy, And as you know, the IDC has traditionally invested in supporting industrial development. And so the sectors that we have traditionally invested in, mining, manufacturing, chemicals, you will now see an increase in energy, sectors such as green energy, in agro-processing, and also in critical minerals. We have been able to make some investment that we believe will pay off in the future.
You've invested nearly 27 billion rand in transformation funding. Do you believe that's being effectively spent? Do you believe that's going to move the dial on what our economy looks like?
So if you look at what transformation funding for us means and where it goes, the majority of it is going into black industrialists. And some of the black industrialists that we are funding in moving into ownership change of entities that may be leaving the country and looking for selling to South Africans. So we believe that keeping and maintaining and sustaining industrial capacity in the country is important. And so if you ask me whether that money is well spent, I agree with that it is well spent.
You'll know, of course, about the 100 billion rand transformation fund that the DTIC Minister Parks Tau wants to create. And it seems to me, Mahoti, if you're spending money effectively on transformation, maybe we should be building on your efforts rather than sort of starting again, which I think is what this fund might be doing.
The question is whether all what we do as development finance institution is enough in terms of resources. And for me, the answer is no. If you look at the IDC since inception, it hasn't been capitalized by the state to do more. And yet we are playing this counter-cyclical role where when the economy is in a slump, we come in and try and support industries in distress. And we are one of the few entities that do that. So I believe that we still need more funding for the type of sectors that we fund. And if it's through supporting the Transformation Fund, we will be working with the Minister and the Department to see how we can partner and perhaps with the experience that the IDC has had over the years to support this initiative.
What I'm trying to get to is maybe instead of a whole brand new fund, we should just give that money to you. You've got experience in it. You know what you're doing. You're comfortable that it's being effective. I mean, wouldn't that be better than starting again?
My understanding is that it is not necessarily starting again. It's a means to mobilize funding. And there's a model that is being looked at which will really see any fund manager that can manage the funds and invest them into the industry and the sectors, then entrusted with that. So it may be ourselves, it may be another entity.
Okay. You've invested 1.7 billion rand in ArcelorMittal. Now, look, I understand why you've done it. You want to support the economy, their jobs that flow into that industry and from other industries from that company. But the management of the company has been pretty clear. Unless government changes trade policy and steel policy, they're not going to ever break even again. And so the risk to you as the IDC is that all you're doing is pouring money, and it's a lot of money, into a company which is never going to be able to stand on its own 2 feet?
Look, it's part of what ArcelorMittal does. And as a private company, it's understandable for them to raise these concerns and take the decisions that they take. For us as the IDC, Stephen, we've taken an industry-wide decision. And the support that we provided at the time when we did, you will recall that there was a concern coming from the automotive sector, for example, to say that, we are going to be left high dry with the specialty steel that we need for production. So for us, the steel sector remains very important. And as you know, with Eskom and the National Transmission Company having announced that they will be inviting private sector participation in transmission going ahead, we believe that this sector is very important. And in whatever form, the IDC stands ready to partner and support industry that comes through to sustain this sector.
Okay, I mean, you make a compelling case, but at some point you have to, you know, there has to be a point at which it stops. You can't keep pouring money into something that's always going to make a loss forever. Someone else should be doing that.
We cannot do this on our own. I think that's a message that we want to give. And I do agree with you. We cannot continue pouring money. And we have not decided to continue supporting ArcelorMittal in the future for its longs business, which is what they are closing. That decision they have made as shareholders. And the IDC is a very small shareholder in ArcelorMittal. We don't make these decisions. However, as I said, what is important is to keep the capacity of the long steel in South Africa as an important contributor to so many sectors. So when I say that we will continue supporting it, I'm not saying that it's going to be through ArcelorMittal. We can do this through strategic equity partners that come in, that have the capacity, or any other emerging entity that says that we are going to continue with supporting this sector.
Makhoshi Lekete, thank you very much indeed. Really do appreciate it. The CEO of the Industrial Development Corporation. You're at The Money Show. It's 10 minutes to 7.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, over the last few years, you've heard quite a huge amount about the company We Buy Cars. Their website now gets about 9 million visits a month. If you consider the number of cars bought and sold in South Africa, I mean, that's a huge number. Rikus Blomorus is the Chief Marketing Officer at We Buy Cars. Rikus, good evening. I mean, there are other people who sell cars in South Africa. A lot of them sell them in the same way that you do. How do you believe you've been able to get so many visitors on a regular basis, and in fact quite quickly?
Yes, good evening, Stephen. So it's not just quite quickly. It takes many years to build a brand. So a lot of people don't know, but We Buy Cars is actually 24 years old this year, and it took some time to get where we are. And it's been a whole digital journey, collecting the data on the vehicles and making good information available to consumers at the end of the day. And then it's about doing the right things and getting your fundamentals into place, targeting the right customers. And luckily in South Africa, owning a car is also a little bit of an aspirational thing. So there's lots of people that visit your website because they've got an aspiration of owning a vehicle.
I mean, so I get that, and that aspiration's interesting. I presume that for every one person who's looking seriously at a Corolla, there's 7 of us looking at your Ferraris.
Yes, definitely. No, but it's all over the spectrum, but definitely some of the nicer, more expensive vehicles does also attract some views, and people, as we said, aspires to own them, and they just dream when they look at them.
I mean, so people come. The question is, do they buy? Now, you might well have some data that can tell you how much they buy, but some of it, where someone will actually pick up a phone and approach you in another way, or maybe see something they like, be attracted to the model on your site, but actually end up buying it from someone else. Are you able to see how many visitors actually turn into buyers at We Buy Cars?
Yes, so we do have a view of the customer. So we know who visits our website, and then from there you log a sales lead or a buy lead where we purchase either your car from you or you purchase a car from us. And then there we know exactly who the customer is, and then we track whether that then converts or not. And if you look at the amount of vehicles that gets registered on a monthly basis, a large percentage of South Africans actually do purchase their vehicles from We Buy Cars. Our current market share is somewhere around 10 and 12%.
I mean, obviously, like everybody else, I presume you get affected by what's going on in the economy. And people will buy if they're feeling optimistic, and they won't if they don't feel optimistic. And I kind of wonder which of those phases we're in right now.
Yes, so I think looking at purely at website traffic, people are optimistic of buying a new vehicle, or a used vehicle. I think interest rates coming down, fuel prices being in a good place, load shedding not being a thing at the moment. I think there's some good economic markers in place for the typical consumer, and they adapt well to it, and they feel like purchasing a vehicle is a good time. So it's definitely a good time to purchase a vehicle now.
How important, how useful is your site to detect changes and trends? So there are lots of transitions at the moment. People are buying more Chinese cars that have come into the market. They're a bit cheaper. I wouldn't be surprised if we see more electric cars coming in soon. Are you able to sort of spot trends pretty early from your website, from what people are looking at? They will look a long time before they buy.
Yes, definitely, Stephen. Yes, we would definitely have trends and know exactly what sort of the price range is that people look at. Are they looking to finance the vehicle? Are they looking to buy it cash? Are they looking to use the unsecured lending channel or so forth? So we've got a pretty good idea of where the consumer is currently in his buying journey.
Where are they at the moment? Are they feeling that they're going to buy?
So they're at a good place, but I also have to take into consideration not just our own data, but maybe a little bit of the industry. I think from a We Buy Cars perspective, it seems like they're at a good place. We could see them being interested in vehicles, interested in our website, or maybe it's just good marketing to get the people there. But then if you look at the industry, the amount of used vehicles being registered is more or less flat on year, maybe a little bit up. But when you look at new vehicle sales in South Africa, and that's actually up a couple of percent. And I think the Chinese vehicles is one of the bigger contributors towards that, because you can now actually on their price points they do compare well towards a maybe more luxury brand. And then you can buy something with a service plan for a certain price point. But again, that depends that's totally up to the consumer. Some consumers are really brand loyal and they would rather choose something else. Then we've got a big segment of consumers that's open for Chinese vehicles, but they also want to buy it used. So then they come to our site. So we do also trade a number of those, and we can see an uptick in the numbers of Chinese imports that we sell.
In talking of China, there is a massive price war in China for electric cars at the moment. And in fact, their government has intervened to try and stop the price war because people are selling cars so cheaply. And by cheaply, I think the cheapest from BYD, it's called a Seagull, if I recall, is if you do the calculations in rand terms, about 145,000 Rand. Now, if you had to sell a sort of four-seater car in South Africa at that price, your website would crash because I think so many people would be interested, right? That at some point, despite whatever tariff we want or whatever, at some point that surely is going to start coming here because the Chinese capacity in those electric cars is just so huge. They can't sell them in the States. There are tariffs in Europe. They're going to come here.
Yes, they are, but it all depends on how well our consumers adapt to the idea of electric vehicles. And we do live in a country where there is load shedding. Our power is relatively expensive. So it's a question of supply and demand, and I think the people that actually wants to buy an electric vehicle should be upper LSM theoretically, because they maybe have solar and can charge the vehicles, but then also again you need to have that vehicle at your house. So it's also now a consumer that has solar, but he also works from home. So it really starts to become a really niche market in South Africa, where the landscape is maybe a little bit different in China. Not to saying that we're not keeping an eye on it. We're definitely keeping an eye on it, but just wondering how the typical South African consumer will adapt, especially taking into consideration that people still have that range fear when it comes to electric vehicles, especially in South Africa, where you have to travel longer distances.
Rikus, thanks very much indeed. Rikus Blomerus is the Chief Marketing Officer at We Buy Cars. Good evening. You're with The Money Show. Plenty to come. We'll look at small business. We will also find out the best cell phone voice quality in South Africa, which network has the best cell phone voice quality. And don't forget investment school as well. Should you invest in unlisted companies and why? All of that to come. It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the SARA Rail Conference 2025, powering progress, connecting economies. Good evening. I'm Stephen Grootes. 6 minutes now after 7 the time. Plenty to come. We'll talk about cell phone network quality when it comes particularly to voice calls in a moment. Keet van Zyl already on hold for you. A small business focus, David Marobe, the Executive General Manager of Impact Investing at Business Partners. Looking forward to that conversation. Keet van Zyl, the co-founder and partner at Knife Capital, and Seeiso Matlanyane is the head of Equities at Prescient Investment Management. They are both going to be on your radio in about 20 minutes from now. We'll be talking, it's quite a big debate. Should you look at investing in the unlisted space? So companies essentially that are not on the JSE, and why would you do it? Why wouldn't you do it? And it's really, as always with investing, it's about risk versus reward. So that conversation to come as well in the next few moments. It's 7 minutes now after 7. Good to hear from you tonight. I know you'll have a view on what we've been talking about, on NERSA, on all of it, on 011 883 0702 021 446 0567 and 072 702 1702.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, a very strange sort of a tidbit or a strange development in what's really been a very peculiar story today. And Business Live were reporting on this afternoon. You may remember the Chinese company, they're a railway company, CRRC, their sort of full name in the legal documents, I suppose, is CRRCE Loco Supply. This was the company that Transnet was going to give a huge amount of money to rebuild or to build new locomotives. And they're also the company that was then accused of corruption during the state capture era, and quite a large amount of money that belongs to them has been frozen through a special tribunal ruling. I think it's 4.1 billion rand. I mean, even in real terms, that's quite a lot of money. The point is that they have been trying to get that money unfrozen. And at the same time, because they're so furious at being accused of corruption, they have not been providing Transnet with spares for the locomotives. And that's one of the reasons we have not been able to actually get the spares and the amount of coal and the amount of iron moving that we need to move. That's one of the reasons why we can't get the spares for the locomotives. So today, CRRC went to court to try and get this money unblocked, 4.1 billion rand. They actually had 3 judges to hear the case, all there. So it's a full sitting, it's what's called a full sitting of the court, full court. And they didn't pitch. There was no lawyer for CRRC. There was no advocate. They did not pitch. They were not there in court. So it's their appeal, by the way. They appealed, and they did not pitch. And in the end, the Transnet advocate said, well, look, I'll have costs, please. I mean, it's your appeal. The judges went, yes, you will have costs. Thank you very much. I mean, what an extraordinary story. Why would you do that? And I mean, it just tells you how, messed up. I mean, what other word is there? Messed up this entire situation is. We've got locomotives we can't use. We can't get spares for them. Chinese who made them won't give them to us because we've accused them of corruption. They deny that. And now it all just gets completely out of hand. I don't know how you fix a situation like this. I mean, we must try to fix it. My understanding is that any of the negotiations have really just not gone in the way that they were supposed to. So, very, very messy, I have to say.
The Money Show, Tech Thursday.
Well, obviously, we've been looking, of course, at the situation around cell phone networks, and there are so many questions around, which has the best cell quality and which doesn't. Confirmation from My Broadband that their survey has found MTN is the best voice cell phone network in the country, followed by Vodacom and then Cell C, which lags behind on this scoring system quite dramatically. Keet van Zyl is the editor at My Broadband. Jan, good evening. I mean, first off, what makes one cell phone network have a better voice quality than the other? Must be quite complex.
Voice quality, so can you hear me?
Sorry. Yes, we can. Sorry about that. What makes one have better voice quality than the other?
Yeah, so in our case, it is a very advanced rig that we drive around the country with that makes thousands and thousands of phone calls and then measures quality. And essentially what you do is you have one thing that we do, besides measuring the time it takes for the call to connect and be set up, and measuring dropped calls, is we also play an audio file and then do measurements on the receiving side to see whether the quality of the audio on the receiving side is good or not. That in broad strokes is how we measure the audio quality.
Okay, and then in the networks themselves, why would one be better than the other? Is it about the age of the network? Is it about the equipment? Is it about something? Is it about the number of base towers, etc.?
No, it's going to be a variety of factors, from configuration, essentially where the antennas are pointed. It can be very subtle things. It doesn't have to be something as major as this one. They could both be running on Huawei core equipment, for example, or rather Huawei radio access equipment, and be achieving quite different results in a particular spot. So no, it's got to do with everything from congestion on the network through to the vendor that supplies the equipment, through to the specific spectrum that they use in a particular area. It's a variety of factors that ultimately affect voice quality at the end of the day.
I would expect MTN and Vodacom to be quite close to each other, and they are, although I look forward to their war of words over which is better because of your survey. But Cell C are really lagging behind on your index at a complicated time because of their relationship with Blue Label Telecoms, which is about to change. But is that also just because, really, they just don't have the same resources the others do?
It's actually surprising, this result on the voice quality side, because on the data network side, Cell C is actually performing quite well. And the reason, the other reason it's surprising is Cell C is actually piggybacking essentially on MTN and Vodacom. So this suggests that whatever is happening at Cell C, it is heavily prioritizing data over voice, or at least its partners are. So depending exactly on how the configuration happens. Now, our particular test probably favored the MTN side of things. They do the prepaid and the MVNO network that for Cell C. At the moment, Cell C does want to kind of be able to switch between the two networks more freely, but right now, if you're a Cell C prepaid or MVNO customer, you're probably on a network that is built and maintained and operated by MTN for Cell C on Cell C spectrum, which complicates things further. But still, this result was surprising because Cell C's data network quality has really improved over the last 18 months.
Well, interesting you mentioned data, because it's one thing to talk about voice quality, but if we all move to WhatsApp calls, it doesn't matter.
Yes, and that's an entirely separate discussion with the mobile network operators, because voice has always been a huge money spinner for them. And, things have been increasingly moving towards data. But yes, we do a whole separate set of testing for the mobile data side of things, and those results also get released quarterly.
Okay, well, I look forward to them, but do you expect, and I realize you may not want to give away too much, Jan, but do you expect data to follow voice? Would they be roughly the same in terms of one being ahead of the other in both, or do you think that actually there could be quite big differences?
There are actually substantial differences. So during our last quarterly results, so MTN comes out on top. So nothing changes there. And MTN actually leads on the data front quite substantially. But that's got to do with its 4G network. When you look at 5G, Vodacom leads. But then if you look at overall, once again, favoring the 4G LTE side of things, Cell C is second. They've overtaken Vodacom. Vodacom's not taking it lying down. They've fought back in the second quarter. And here, where Rain's voice quality was about the middle of the road, it comes stone last in data quality on our data surveys. Wow. And has for years. So yeah, there are actually substantial differences between the rankings.
Jan van Meulen, so much to talk about. Thanks very much indeed. Editor at mybroadband.co.za.
The Money Show, small business focus.
Small Business Focus is brought to you by Capitec. Start up or scale up with Capitec, the business bank for everyone. I find some of these surveys around small businesses really interesting. They can sometimes give you quite a different picture. I mean, you might have heard a survey recently suggesting some people in the small business sector are pretty gloomy in their outlook. They believe the economy won't help them grow their businesses. But there's other data which suggests, in fact, 84% of SMEs, small and medium enterprises, believe their firms will grow over the next year. 2/3 believe the economy will help them grow. David Morobo is Executive General Manager for Impact Investing at Business Partners. David, good evening, and thank you so much for coming in tonight. I really appreciate it. I mean, I get that people who run small businesses are optimistic by nature, but considering the economic numbers around us, this is a group that's being very optimistic.
Indeed, they are. I mean, this is the sort of feedback we get from our entrepreneurs. We try by all means to gauge what their feelings are about the economy, what their feelings are about their own businesses. And that's the feedback we get. I guess they are eternal optimists, even in the face of adversity, as we are experiencing all.
Yeah. There are good and bad ways to give companies funding. I mean, that sounds like a strange thing to say, and I think a lot of companies will say, just give us the money. But are there some ways now, and there's a lot of research in this, that really shows how to get the best bang for your sort of small business buck? Are there ways in which you can really see, actually, this is now a much more effective way? If you give money in this way to an SME, you will actually have much better results.
Well, it's about matching the funding need. I think the biggest risk is to fund a short-term need with a long-term type finance and the other way around. It's important to be responsive to the need in terms of time, in terms of, trying to also add value to that particular business, because finance alone doesn't always make it. So I think it's a combination of factors depending on what it is that the entrepreneur needs at the moment. The quicker we can be responsive to that need of the entrepreneur, and hopefully when they can give the sort of return that the funder needs, and they're able to grow whatever business purpose for business that they want the funding for.
I mean, one of the things, and you see this all the time in different parts of government, is that there will be a group of people about whom or for whom or whatever government is making a policy. And the policy is meant to help them. But in fact, they're not really asked or consulted. There are lots of court rulings about this very idea of meaningful compensation. Does it happen about meaningful consultation? Does that happen with smaller business owners too? Lots of people draw up policies. No one really listens to them.
I think that's the clarion call that we are all putting to the SME ecosystem. That's why we do the Business Confidence Index. There's a need for engagement, because we all want an easier environment for SMEs to sustain themselves and to be able to flourish. So government must realize that they alone cannot solve all the problems of the country. You need the private sector to collaborate with government to see what it is that we can bring to bear for the benefit of our small businesses per se. And in that way, we are able to have as a corollary the jobs that can be created by these sustainable businesses. We have to engage, and that engagement doesn't have a finite period. We have to engage all the time what can be done. We have our young people unemployed, or there's just high unemployment, but the young people component is even higher. Unless we do something and talk and get private sector involved, then we're going to have a continual problem. And this lack of engagement actually is a surprise.
Why do you think that is? I mean, is it because there's something specific in the small business sector? Does the small business sector maybe just so diverse that there are different views in the small business sector? Or do you think that there's this kind of top-down approach? We know what's best and we've got the money, therefore we can make the decision.
Indeed, I think it is diverse. I think that's the thing. When some people talk small businesses, they're talking micro, informal. There's those that are talking sort of emerging small businesses that have formalized themselves. There are those that are talking sort of private equity needs, and you have sort of the venture capital almost on the verge of breaking into big business. So are they all requiring the same type of voice? We need to have almost diverse mechanisms of engaging the respective needs across the board and try and tailor the funding to their various different needs as it were. It can never be a one size fits all. That's why we need to engage across the spectrum.
I mean, another big part of this, and something that comes up all the time, is issues around red tape, bureaucracy, actually accessing the kind of money that is supposed to be available, the kind of money. And is that, I mean, I understand. I mean, sometimes it's government money, sometimes it's money that, it needs to be used effectively. But can we sometimes just make it too difficult, actually, for people to access?
Unfortunately, that is most often the case. And when we talk about an environment that is easier for the businesses to trade, we're talking about some of these bureaucracies that our small and medium businesses encounter in the marketplace. Not only is it about getting money into their hand, there are several aspects where we see the regulatory burden being quite cumbersome on many entrepreneurs. It could be just dealing with your local government, which can have certain efficiencies just from getting a license or permits to be able to develop properties. These are things that are unfortunately could be better efficient and better enable the money to flow, because that could be a condition for a funder to be able to give you the money. And if the other party doesn't come to what is required, unfortunately, that delays that money landing into the entrepreneur's hands.
I mean, part of it also, and you see this with small business owners, people starting small businesses, that they're quite like a network. And I wonder if networks can be quite powerful in these moments.
I think the favorite term of late is that social capital. And I think that's important for us to try and open it up for entrepreneurs because when they meet others, they can benchmark themselves. They can get some value about what's happening in the marketplace. Sometimes when they get those that are better than them, just from the ecosystem, including policymakers, including financiers, you can have that warm body introduction when you really need it for you to be able to get access to either market or finance or any other opportunity that could come to bear. So we cannot overemphasize the need to be able to network because it opens up so many other doors that wouldn't otherwise be open to you.
I mean, we know how important small businesses are to our economy, and I always worry a little that actually one day we're going to have lost a big part of something that's very important. People talk about it all the time. We talk about it all the time, creating jobs. I just don't know if we're actually seeing enough action from all sorts of sectors.
Across the board, everybody acknowledges that it is an important sector. And yes, we need to do more. Hence my earlier statement about that collaboration, because we're all working in our own little corner. If we want a systemic change, we need to come together and say, why is it so difficult in certain areas for entrepreneurs to get access to the opportunities and support that they require? If you look at the current support base, it's mostly concentrated around the metro hubs. It could be Johannesburg, around Pretoria and Cape Town. How do we spread it to far out areas? How do we spread it to the rural towns and even the townships? So this is the sort of engagement we need to require so that we're not just talking all the time about entrepreneurs getting help, but actually delivering that very help that they require through a coordinated system between government and the private sector.
David Marobe, I really appreciate you coming in tonight. Thank you very much indeed. The Executive General Manager for Impact Investing at Business Partners.
The Money Show.
Investment School.
The Investment School is brought to you by Absa Business Banking. Talk business with the bank that gets it. Absa Business Banking. Well, you'll hear all the time in business reports, a lot of the conversations that we have here on The Money Show for you about shares that are listed. The share price did this, it did that, and all of that usually comes from companies that are listed on the JSE. And with that comes all sorts of things. I could tell you, if I wanted to, how much money the CEO of Vodacom made last year. I could tell you how much the chair of this or that made in the last financial year. And that's because they're listed. When you get into the unlisted space, which is where a lot of companies are, you don't get as much information. But there are advantages too. To discuss that this evening is Seeiso Matlanyane, is the head of Equities at Prescient Investment Management, and Keet van Zyl is the co-founder and partner at Knife Capital. Gentlemen, good evening. I really do appreciate you coming into our Cape Town studios. It's nice to see you here. It's nice to have some company and not just George and I in the Cape Town studios. So thank you very much indeed. Seeiso, let me start with you, if I may. The listed space we kind of hear about very often. So I kind of feel that we know it. The unlisted space, not quite as much information available.
Yeah, no, 100%. And thanks for having us. Yeah, so, I mean, the listed space is where all the information is pretty much readily available, right? These are public companies, meaning that everything about them is ostensibly made public, right? So they operate in a highly regulated environment. There's full transparency around their, disclosures and whatnot. But the unlisted space, like you said, that's the private market, right? So these companies are under no obligation whatsoever to disclose particular information. They're not traded on a particular platform where you can just simply look them up, and therefore they're a little bit more opaque and a little bit more, require special expertise to be able to navigate that particular terrain or landscape.
Keet, if information matters to investing, and obviously it does, why would you then go into the unlicensed space, into the unlisted space?
Well, unlisted and unlicensed sometimes.
Yes.
Well, there's the interesting word called due diligence, which is another word for homework. So you would only tread carefully into this space if you actually ask the companies that you would want to back for a list of things, do your homework, and basically use that whole concept of an inefficient market, which is a little bit of a dark art, and hopefully get some outsized advantages on pricing and growth.
So by an inefficient market, you mean I know less than someone else, and therefore someone else can make more money than me?
Yeah, I think the concept of startups or high growth startups, if you just think in simple terms of a typical company life cycle growth curve, there's some point it starts, then it's a steep curve, learning curve, growth curve, and then at some point it becomes a more mature company which flattens off. And then if you can time the market well in that growth curve early on and ride the wave towards a listing or towards an exit, which we'll talk about later. But it's inefficient in a way that there isn't perfect information. It's not a lot of analysts that talk about the company. There's not information, as you said earlier. You don't know how much the CEO owns, or the public market doesn't. The investor should. I mean, you can't go invest blindly, but that's what the due diligence is for.
Okay, so to put it to one story that we know, if you invested on the day that Capitec became a listed company on the JSE, you would be very rich now. But if you'd invested in Capitec, actually when it started before that, you'd be even richer now.
Exactly. So if you had an in and you maybe knew the founders when they actually were, maybe they were never that desperate, but when they were at some point, private investors back them, and that's the point. The growth is much steeper there, and in that particular story, post listing, still lots of value today. So the growth continues, but that's exactly a tangible story to hang your hat on.
So Seeiso, that's a happy ending story, right? There are lots in the unlisted space that are not happy endings because maybe you did your homework very badly.
Yeah, exactly. I mean, ultimately, what you're looking for is a way to be able to get safely into an investment and then get out, like you said, with a happy ending. But so often is the case that things go wrong, things slip under the radar. The homework or the due diligence is not thorough enough, and maybe a couple of T's were not crossed and a couple of I's were not dotted, and it could result in a train wreck. But same goes for, I think, any type of investing, whether you are in the listed space or you are in the unlisted space. I think the key distinction is that in the listed space, there's a bit more scrutiny, there's a bit more eyes looking at it, that therefore gives you a bit of a guardrail, a bit of a safety net.
You can also see what other people are doing, whether they're dumping the stock or buying it.
You can to some extent. I mean, so the price is the reflection of the direction of, whether people are buying or selling the stock. But ultimately, the transparency in the listed space is an attraction, and the accessibility in the listed space is the attraction. But it also comes with its own drawbacks, and some of those are nastier than others. So there's quite a bit of volatility, could be sentiment-driven volatility, because basically anything that happens sort of hits the public and is immediately reflected in the perception of of that particular company via the share price.
Keet, that issue of volatility. If you're in the unlisted space, you probably need to have a bit of an appetite for it. This is not something where you just invest and forget about it like you can with an index tracker or something. You have to actually be quite an active investor.
Yeah, and diversification also counts. So I would, as a definitely keen venture capitalist and backing South African startups particularly all the way, I would be the first one to say that your alternative asset portfolio needs to be part of a balanced portfolio.
Yeah.
So don't only invest there. And then when one invests in a unlisted space or an alternative asset class, it itself should be diversified. You can't just back one company and hope for the best, because then you're bargaining a lot on luck. But it is illiquid, so you need to be along for a long journey, because it's not as if you can wake up maybe 3 years later and say, well, I actually want to now sell my shares in this company. You can, there's a process and stuff, but selling shares in an unlisted company is not the same as phoning your broker or going to Easy Equities and just sell. So it's a longer term view. It's much more illiquid, but in that lies also some advantages. And you need to be as active as one can be. Not everyone is a venture capitalist, but in our case, for instance, we would want a seat on the board. There's some minority protections. There's some influence that we can have, information rights. And generally, you will invest where you can actually have an advantage of connecting some dots into a value chain that you already know. So in our case, it's specifically innovation or technology-driven businesses, and with proven traction that we help scale, mainly internationally. But some others as education technology funds or health tech funds or something that's in a vertical where there's already a portfolio of companies, already a knowledge base and channels that one can plug it into. And that's sort of the holy grail,
Should you also be careful of how much you invest in unlisted shares? You don't want to put all of your eggs in that particular basket.
No, I think in a typical balanced portfolio, it should be around 5 to 10% of your assets. But if you are a bit more have an appetite for risk, or it could be up to 20% or so. But even the Silicon Valley venture capitalists, when they start making their money on carried interest, and that they would use their personal wealth, but only put 15-20% behind these type of assets. So that's kind of the metric. I don't think it should be zero, but if you're conservative, probably should be 5%.
So I'm trying to think of it now from the company's point of view. Right. So there are advantages to being listed. I realize there are costs, and listing comes with costs, and we know that. I mean, you saw that with Volterra Platinum, for example. There were costs.
Yes.
But what is the advantage to being listed? Everybody knows how much the CEO earns.
Yes.
But what is the advantage then to being unlisted? I mean, for the companies, they have to make a decision about what to do.
Yeah. So, I mean, ultimately, all companies go to the markets to try and raise capital, whether it's for expansion, whatever you. The decision, or one of the big aspects in the decision to whether go listed or unlisted, will obviously be around the regulatory environment that you're then walking yourself into. So, if you are a company and you happen to be big enough that you can be listed, we find that the reporting requirements and basically the regulations around the listed space can be quite strenuous and can be quite onerous on the companies, and therefore they might just prefer not to operate within the unlisted space, where they can maintain a certain amount of control around their affairs. And I think that leads nicely into the control aspect as well, because if you are in a public space, you've got all sorts of shareholders, multiple shareholders in instances, whereas in your private space, then you can sort of, if you're lucky enough, handpick and have a select group of people that you work closely with as owners of this company.
There comes a point, I suppose, for a lot of companies when you get, size matters, right? When you think of the bigger companies, you're thinking of often listed companies.
Yes.
Not always, but often.
Yeah, no, 100%. So for the most part, the bigger a company gets, the more likely it is that it will eventually become listed and operate within that listed space. And also some of the regulatory burdens and the reporting requirements, etc. Once you're bigger, you can sort of absorb that. They're not such a big part of your fixed costs, etc. You have the human capital, and you can actually absorb them. Whereas a smaller company or like a startup, venture company, that could actually be quite onerous, especially on the day-to-day operations.
I mean, there's the thing about scale. You get to a point where if you're a retail chain, you can maybe be unlisted if you're just in Johannesburg. To be in Gauteng is actually quite difficult, and to then be across the country, you're going to need so much capital.
Exactly. The listed space obviously gives you access to easy capital or accessible capital, whereas in the unlisted space, it's not maybe so accessible. There's I think as an investor, there are higher barriers to actually entry, unless of course you do it via a fund. But it's not as easy as pulling out your phone and simply just saying I'm going to deploy my capital in company XYZ.
Keet, I mean, we see a debate from time to time. Is the JSE attracting as many listings as it used to? And there was a time when they seemed to be losing. They seem to be gaining some now, from what I can see. Is there something that the JSE has done, or something specific that has affected the decisions companies have made about listing or not? I realize sometimes some things are out of their control. Some things are about much bigger decisions, again, like Valterra Platinum coming out of Anglo American. But is there actually something in the environment that kind of leads to a trend of, listing or staying unlisted?
Well, yeah, unfortunately, South Africa, but it's also an Africa-wide problem that listings aren't, they are few and far between. So in the venture space, and even in general. So typically, how this should work in a market is, as typical company has its early stage growth, it is quite good to be nimble by not having to disclose all your moves, in terms of your strategy. So what the great thing about listing a listed company is that you have access to capital, maybe easy, but you have to put a SENS announcement out basically every time you do anything. So you have to give the market information to be able to assess you and make a near perfect decision. Whereas you don't have to do that as an unlisted company. And specifically technology, intellectual property rich companies specifically do not want to tell the market exactly what they're doing or what their next market is or what their moves are. And so I think from that perspective, it's good. The JSE specifically is working quite actively with the private equity community to try and figure out how can we facilitate more listings on the JSE. There are some other alternative exchanges, including Cape Town, where they are trying to find ways of creating liquidity, because that's the one thing holding our industry back, is to say, well, it's fine to get in maybe, but how do you get out? How do you create that sort of secondaries market and so forth? So a lot of moves are being made, but the bad news is not enough. So the main exits, and exit basically is how do you sell the share. So a typical environment is you invest in a business, take a local startup like Quicket, ticketing business, which some people may know, which we've invested in early on with some great founders, Jamie and James and Mike. Help them grow. They did their thing, we did our thing. We went through the wiggles of COVID together in the ticketing space. Sure. And then last year sold that business to Ticketmaster.
Yeah.
And it was a very good return for all of us involved, and that's how it should work. But that's typically how we as South African investors exit these businesses, is by a trade sale to a strategic partner. So someone realizes that they want to get into this African market, or it's a local company that wants to go after a specific channel, or they want to insource innovation. A lot of these entrepreneurs are unemployable. Yes. So you have to do what we call an acqui-hire. So you acquire the company to hire the team type thing. So there's a lot of M&A activity in building a business where it happens now with AI, people trying to get ahead of AI. There's a lot of boardrooms as a buy or build decision to be made. Should we try and get onto this, or should we buy a nimble company that already has got their heads around this? And that's sort of how the liquidity works. But to answer your question, a lot of people are getting their heads around how do we facilitate liquidity through listings, but it's not happening.
You're with Investment School on The Money Show. We're speaking to Seeiso Matlanyane, the head of equities at Prescient Investment Management, and Keet van Zyl, the co-founder and partner at Knife Capital. 9 minutes now to 8.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the SARA Rail Conference 2025, powering progress, connecting economies.
Youth Investment School on the Money Show this evening. Keet van Zyl, co-founder and partner at Knife Capital. Seeiso Matlanyane is head of equities at Prescient Investment Management, talking about the virtues of unlimited, keep saying that. Everything's unlimited, obviously. Unlisted versus listed companies. Which should you invest in? Seeiso, do you find, so I mean, it was an interesting comment Keet made a moment ago that, for example, AI companies don't want to give away much information. They don't want the full transparency.
Right.
Do you find major differences in sectors in terms of whether a company decides to list or not? In other words, do you find in retail or mining, they all list because they're older and national, whereas in some other sectors, maybe they don't list?
Yeah, that's an interesting one, actually. But I mean, anecdotally, I would say not necessarily. Again, I think it's more the size of the company as opposed to the sector that it's in. But I could ostensibly see how that could be a factor. So like Keet said, if there is very sensitive information and you don't necessarily want to put that out there, then you might not want to be. But if you have a moat and you have a solid barrier to entry that would make it very difficult for competitors to sort of steal your IP, then whether you're listed or unlisted doesn't actually really factor into the equation. So to answer your question more bluntly, not necessarily. I think it's more a factor of size and finding that the bigger the company gets, then the more likely it is to be in the listed space as opposed to a specific sector.
Keet, I mean, some companies have delisted. So, in fact, this radio station is owned by one of them, Prime Media, Royal Buffer King, Bell Equipment. I mean, they delisted. And I presume that some of the people who were invested when they were listed have kept their positions, have kept their shares.
Yeah, look, the M&A industry also has to make their money, and the bankers, so there is an ecosystem that facilitates delistings as well as listings, M&A activity, and there's various reasons for delisting. But yeah, it's sometimes the legal depends how the delisting works. Sometimes you get dragged into having to sell sometimes. But yeah, if investors are sometimes given the option to stay in, or groups of investors are, as you mentioned earlier, the companies themselves may. I mean, you wouldn't just randomly go into a delisting. There would be some shareholder block behind it, and there would be some strategies involved. And sometimes liquidity is built in, and sometimes it's not. But yeah, if you are going from a listed environment to delisted, you are going into the territory of not that easily selling your shares anymore until another liquidity event, or until there's a secondaries market or some self-liquidating instrument. So sometimes it's pref shares or something like that. So yeah.
It's interesting to me that when you invest, if you buy shares on the JSE, the company's doing a lot of the work for you. It's very transparent. It's quite easy to access. If you are in the unlisted space, you're doing the work for the company. And is that a big enough factor, Seeiso, to actually bother with, or does it not really make much of a difference?
Oh, I think that's more of a question for Keet, to be honest. Given that we exclusively operate in the listed space, but yeah, I think I'm interested to hear his thoughts on that.
Yeah, look, I mean, one mustn't also make it demystify it or too much. But the bottom line is, if you are investing in your friend's coffee shop, you are doing an unlisted investment, so if you are, and sometimes it's based on called an angel investment, so a private individual that can make a quick decision. Sometimes it's based on backing the team or knowing the man. So it is a big factor. I mean, in this space, there is a cliche, it says back the jockey and not the horse. So if you can back the entrepreneur, and you know them and you know the industry, and that is a way to do it. And maybe there's lighter due diligence at the beginning, maybe there's less money at risk, and specifically in Cape Town, lots of angel investors internationally and locally that are backing startups at the early stage. But then at some point, 1 million rand becomes 10 million rand. As you said, these companies are constantly, unfortunately, having to raise, to fund runway, to fund new technologies and new markets. and then you have to start going towards more structured funds. So how that works is people like ourselves get our capital commitments from banks and international angel investors and family offices and so forth, and then we deploy it on behalf of them, and that's much more structured, FSB licenses and all the rest. And you have to obviously have the paper trail of how did you value the business. You have to have information rights. You have to have disclosures, and it's difficult for retail investors to get into that space. So that is more again institutional. So South Africa did dabble into incentives to incentivize 12J famously to incentivize retail investors to go in there by giving them tax breaks. And what you're actually doing is you're creating jobs, you're fostering innovation, and you're creating your future tax base by investing in companies. And most markets have that. But without that, it's difficult for retail investors to get into the market in mass.
Yeah. Yes. It's interesting. I mean, Seeiso, that does mean really that this is a game for professionals. I mean, institutions.
Yes, no, absolutely. And I think institutional investors will definitely have the expertise and the know-how and the manpower to be able to do their due diligence, that homework properly, as opposed to perhaps the man on the street who might actually expect that, okay, maybe I'll buy this unlisted share because I have a feeling, but then they realize, 2 weeks later, oh, flip, I need my money back, and then realize, no, but I'm locked in for a certain amount of time. So, it is a game for professionals. It's very, there's a specific expertise level required for that.
Well, gentlemen, thank you both for coming in. Really do appreciate it. Seeiso Matlanyane is the head of equities at Prescient Investment Management. Keet van Zyl is the co-founder and partner at Knife Capital on Investment School this evening.